Good afternoon, everyone. For the company fundamentals and financial analysis part, I'd like to start off by highlighting that whenever we're analyzing companies, the value of the company, it all revolves around the earnings of that company. Well, to be technical about it, it's really the cash flows or the dividends that corresponds with that level of earnings. But at this point, I'd like to just use them interchangeably. Right? So whenever we're analyzing a company, whenever we're looking at any particular variable that we wanna analyze, we always tie it back to the impact on earnings. Right? So it follows now that when we're analyzing our subject company, we look at any and all factors that could impact the future earnings, like competition, like the economy, product, and so on and so forth. So for example, if the competition, you know that, let's say, a competitor is launching a new product that might compete with your company's product, then again, the question now becomes, how would it affect future earnings of that company, right? If the economy, for example, is facing high inflation or high interest rates, then again, how would that affect the earnings of the company? So everything, we tie it back to earnings. So in fact, this is why we say that investing is ultimately entrepreneurial. So we always need to understand the impact to the earnings. Okay, so what is it about earnings that we particularly like? So two key things, right? Growth and sustainability. I think this is intuitive enough. The higher the earnings growth, the more attractive the company is, and the more sustainable that earnings is, of course, it also becomes more valuable. Okay, so we always have to keep this in mind. Okay, so this is probably the most important slide that I have for today. Whenever you're presenting or doing your analysis, these are the main questions that you need to answer. So first, what is the outlook for earnings, right? So do you expect it to go up? Do you expect it to stay flat? So how fast, or even possibly decline, right? So what is the outlook for earnings? And then next, let's say you think that it's going to grow by 10% a year. What would mainly drive this growth, right? Is it the expansion plans of the company? Is it increasing prices, so on, lower costs, so on and so forth, right? And then lastly, what are the risks to this assumption, right? Of course, even if we're expecting earnings to grow, sometimes there's something happens, right, that causes the earnings to decline, right? So we need to basically touch on these 3 points whenever we're presenting, right? Okay, so yeah, so 2 key points. First one, so I've mentioned in the couple of slides back that there are several factors that could impact the future earnings of the company, right? But I'd like to point out that not all the variables are equally important. Okay, we don't really have to talk about each and every one of them all of the time, right? Our challenge is to identify which of these variables have the most impact on future earnings, and that's where we're going to be focusing most of our discussion around. Okay, so not all variables are equally important. And number 2, if you notice, these 3 questions are forward-looking questions. What do you mean by this? All the questions basically answer something about the future, right? What is the outlook for earnings, right? Earnings tomorrow, earnings next year, 3 years from now, 5 years from now. That's what we're talking about, diba? What would mainly drive this growth going forward, right? For the next 5-10 years, right? Everything's about the future, right? And the reason for this is because markets are forward-looking. What do we mean by this? Markets care more about what would happen tomorrow or in the future than what has already happened yesterday or in the past. So just to illustrate this, the simplest way I can is to give you an example. Okay, so let's say you have 2 theoretical or hypothetical companies, right? Companies A and B. Let's say for company A, they made, let's say, 1 million pesos per year each year over the last 5 years. But going forward, you don't expect them to make any more money. So 0 earnings for the next 5 years. Let's say that's company A. Then we have company B. Let's say for company B, for the last 5 years, you didn't make any money, but for the next 5 years, you expect company B to make 1 million pesos a year going forward, right? So I think for this example, mostly everyone, or if not everyone, would choose company B if given that choice, right? Because again, we care more about future earnings than historical earnings. Okay, to clarify, I'm not saying that we can just straight away throw out any historical event or number that we have, right? It's still useful to analyze historical numbers because it helps us predict or anticipate what could happen in the future. But again, the focus is still ultimately about the future earnings, not the past earnings. The past performance is just there to guide us in our analysis. All right, so I hope those 2 points are clear. Okay, the next part, I like to note also that in doing your fundamental analysis, there are 2 important parts, no? The qualitative or the narrative and the quantitative side, which is the number side, no? So because the common misconception is that whenever we're doing, company analysis or fundamental analysis, the misconception is that it's all about crunching numbers, fixing your model, applying formulas to compute for values. That's usually what people think of. But in reality, this is at most like 50% of the game. The more important part is, again, the qualitative analysis of what we talked about a while ago. Basically, the factors that impact the earnings going forward. It doesn't have anything to do with the numbers, right? So a good analyst would be able to combine both the qualitative analysis and the quantitative analysis to support their arguments. So you have to be able to do that. So just to give you some examples, okay? So let's say your narrative is that the company has strong pricing power. So let's say a company, let's say Apple, you think it has, a good brand with very loyal customers. Therefore, they have a strong pricing power. They can command higher prices, right? So if that's your narrative, that's a good narrative, right? But it has to be supported by numbers, right? And in particular, we could probably verify this by seeing high or increasing gross margins, right? That's how it translates to the financials of the company. Another example is that if you say that, okay, company XYZ is capitalizing on a big trend that's happening today, right? Whatever that is, right? Then again, you should expect high or increasing revenue growth, right? And so on. So these are the other examples. You could look at it on your own time, right? But the general idea is these 2 parts of fundamental analysis, they work hand in hand. No? If you're an analyst that just focuses on numbers, the tendency is for you to be very limited in what you could pick up from the company. On the other hand, naman, if you're just too focused on the narratives, then it's very difficult for you, like to quantify or to measure the impact of these narratives, right? So again, a good analyst would use both, right? Complementing each other, right? Of course, these are just some of the differences between the narratives and the numbers, right? In general, the advantage of narratives is that it's more intuitive, easier to pitch to the panel of judges that you might be presenting it to, and also easier to perform on your end. So much easier to spot, much easier to understand, right? On the other hand, again, you need the numbers because they're more measurable, they're less biased, right? You can't simply say that the company, for example, has a very good product, but nowhere does it get reflected in the numbers. You can't say that, but it's less biased, right? So the way I see it is that the qualitative side and the quantitative side, they supplement each other and they make for a better argument and analysis. Okay, so I want to go through just quickly the major parts of the financial statements right? And just highlight the important metrics that you need to look at whenever you're analyzing companies. Okay, so first for the income statement, of course, the most important is to look for revenue and cost drivers. So look at the revenues, look at the major sources of revenue. Sometimes a company has multiple product lines or service lines, so you have to break down the revenue and see what could potentially drive that growth going forward, right? And also do that for the cost drivers. Again, I'd like to reiterate that not all lines are created equally, right? So just focus on the most important parts. Okay. And of course, after that, you could also look at margins and growth rates of that company. So for margins, you have gross margin, you have operating margin, and net margin, right? So these are, of course, these are not comprehensive, okay? But at least, at the very least, you should be looking at those and trying to understand what it implies for your company. Next, for the growth rates, again, we look at the major parts of the income statement and try to match it with our qualitative analysis to help our overall, analysis of the company. Yeah, so basically that's it for income statement. Again, I'd like to highlight at this point, whenever you're doing this financial analysis part, the goal is not really to compute, okay? The goal is not to compute the margins or to compute the growth rates or whatever, the leverage, whatever ratios that you might have learned in school. That's not the goal. The goal is to analyze the company, to tie it back to your, to the qualitative analysis of the company that you're looking at. Okay, for the balance sheet, I guess the biggest thing that you have to look at would be the sources of funding, right? So there's two main ways to fund your asset growth or your capex. It's either through debt and equity, and there are consequences for each one, right? Of course, you know that everybody knows the difference between debt and equity, right? For debt, you have fixed interest payments. For equity, no fixed payment, and also no set maturity date, right? So if you understand the difference between the two, then we can extend that analysis to the riskiness of debt and equity. That's the most important thing, right? Debt magnifies your gain during good times, but during bad times, it also is more worrisome, right? The higher the debt level that you have, right? So that's what you need to look at when you're analyzing your balance sheets. Okay. For the cash flow statement, we break it down, of course, to the three major parts: cash flow from operations, from investing, and from financing. And the reason why we're primarily concerned about the cash flow statement is because even if the company, for example, is generating healthy earnings, it doesn't mean that the company is liquid or solvent, no? Because at the end of the day, what the company needs to pay off its, let's say, salary of its people, to pay off its suppliers, and so on and so forth, its rent, it needs actual cash, but they can't use earnings to pay off those things, right? So analyzing the ins and outs of the cash flow statement is very beneficial, right? So cash flow from operations tells us the day-to-day, the ability for day-to-day operations to generate cash, right? I think that's straightforward. For cash flow from investing naman would be from acquiring and or disposing long-term assets, so the cash you get from there. And then from financing, cash you raised or used to pay either debt or equity transactions. Okay, so here are some of the questions that these line items could potentially answer, right? So when you're looking at operating cash flow, it basically answers the question, okay, how sustainable is the company's operations? Will it need to raise capital? Can it give out dividends, right? So if it's a positive number, then generally the answer to these questions would be yes, right? The bigger the number, the healthier it is from an operating cash flow perspective. Investing cash flow naman, answer the questions, how much is the company reinvesting in the business to support future growth? Okay. And then for financing cash flow, how much funding is the company using up? And of course, the total, that's the net increase in cash after all activities. Okay, so that's how we try to use the cash flow statement again to aid our analysis. Okay, so my last slide for my part is this one. So again, when you're doing your financial analysis, you're gonna be encountering a lot of numbers, right? A lot of growth rates, a lot of margin numbers or ratios, right? And again, I've said it a while ago already, the objective is not just to compute them, but to interpret or to analyze a company, right? So, and the way to facilitate that is either by comparing those numbers that you get or that you observe to its peers, the peers of the company, to the industry or sector average, and or to the historical average, right? So that's how we make sense of the numbers that we see, right? So again, there's a lot of different things that you could ultimately use to perform your fundamental analysis and your financial analysis. But again, as my last pointer to you guys, just make sure to focus on the most important parts that would impact the future earnings of the company. Again, this is not only because of the limitation of the event, okay, wherein you're restricted to 5 minutes and to a page of report. In real life, this is also the case because I mean, nobody really wants to read a long report just to know what to buy or sell, right? So again, yeah, so that's it on my part. Thank you very much, guys, and good luck.